And I think the next phase up in gold will be fairly dramatic because the flow from that broken asset category will enhance it. It will also spark the central banks into craziness again. If we break out of the current pullback in silver versus gold, which we argue is now commencing, we're starting to see the breakout, we're going to gush not only to the 2% level, which is to say almost double the price of gold and silver in relation to gold as it is now. So that could mean a tripling of the price of silver at its current level to gold.
Gold prices surged past $3,050 per ounce in 2025, continuing a powerful upward trend driven by shifting global financial dynamics. One of the biggest drivers behind this rally is the aggressive accumulation of gold by central banks, which has reshaped market dynamics in an unprecedented way. In 2024 alone, central banks added 1,045 tons to their reserves, marking the third consecutive year of net purchases exceeding 1,000 tons, according to the World Gold Council. This growing demand reflects a broader push for monetary sovereignty as nations seek to reduce reliance on the US dollar amid concerns over financial sanctions and geopolitical risks. Economist Peter Schiff argues that central banks act as insiders, quietly shifting away from the dollar and accumulating gold because they anticipate major changes that the public has yet to realize. This shift raises questions about the future of fiat currencies and the potential for a broader realignment in global financial markets. Historically, gold has thrived during periods of economic uncertainty, and with inflationary pressures persisting, investors are increasingly turning to the metal as a safe haven. Analysts suggest that the scale of central bank purchases indicates a long-term strategic move rather than a temporary reaction to market fluctuations. Market analyst Michael Oliver highlights that gold bull markets typically follow multi-year rallies, often delivering gains of approximately 800% from their lowest points. This pattern was evident in previous cycles, such as the late 1970s and early 2000s, when economic instability and shifting monetary policies drove dramatic price increases. Since the current rally began near $1,000 per ounce, historical precedent suggests that gold could follow a similar trajectory. With global debt continuing to rise, geopolitical tensions escalating, and trade policies evolving, the conditions that propelled gold to record highs remain firmly in place. If this trend continues, gold prices could surpass $8,000 per ounce in the coming years, reinforcing that gold remains a cornerstone of financial stability in an increasingly uncertain world. We present the clips of Michael's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
It turned up as of February 2016 by our metrics, by using annual momentum. It has not negated that. In other words, we've had plenty of stalls, we've had pullbacks. There was a 20% pullback in the 2020 to 2022 low, for example. 20%, if you consider that major, you had one. But it didn't break the major uptrend in gold, the momentum uptrend. Scared price people all along the way. You've scared all the price folks out, in and out, in and out, and that's the top. Oh no, etc. And for some reason, because we're humans, I guess, round numbers catch people's attention. Indeed. Remember the trouble just over 2,000. For a couple of years, we get over 2,000, they'd sell it, they'd sell it, they'd sell it. That's not the way you top a market. You don't go back to the high again. If you do, it says you're going through. Okay, well, we finally went through. Now we got 3,000 crowd. Okay, just like we have the $35 crowd on silver. Okay, which we've been to twice now, by the way. So I think this is merely another pause point, and I think the key factor for gold has been for recent months the need to break the stock market, U.S. stock market bubble, because when you punch a hole in that beast, the money will flow elsewhere, and historically it has always flowed into gold. Not that gold waits for that. After all, gold's been going up anyway, right? Okay. But it helps infuse the dynamics of gold because it creates a river flow of new assets that are seeking safety. And I think we're already starting to see that now with the topping of the stock market. And I think the next phase up in gold will be fairly dramatic because the flow from that broken asset category will enhance it. it will also spark the central banks into craziness again. Price targets are going to be hard to determine this time because I said the bubble is the biggest in history. When it breaks, the consequences will be bigger than other ones. And therefore, the dynamics in the monetary metals could be awesome. I've cited before, people say, oh, he's predicting 8,000. No, I simply said that over 50 years, gold has had two prior bull markets, each of which were eightfold moves from bear low to bull high, different span of time. One was 3.5 year process, mid 76 to 1980. One was from 2000 to 2011, 11-year process, but both were eightfold moves. Well, an eightfold move for us now would be $8,000 plus. Just to match the ratio moves of those two prior markets. And the conditions that drove gold up then were hardly as dynamic under the surface as they are right now. So if gold went way past 8,000 and went to 20,000, it wouldn't shock me. I do not have a specific target, except to say seatbelts. Therefore, I cannot come up with technical swing objective targets on the upside. Except to note what has happened over the last 50 years is two eightfold moves under conditions that are hardly as dynamic as what we're sitting on right now. So, and also another thing, a point I make is I don't think the next, quote, top in gold, wherever it may be, is going to be a top as we normally think of one. I think it's simply going to be a new price level reality. It's not going to collapse back to $500 an ounce or anything like that. I think the world will go to gold because the financial crisis that follows the stock market bubble breakage will cause rethinking of many things. Rethinking of the validity of the intellectual viability of central banks, for example, and a move back to gold standard currencies.
Michael Oliver has been one of the most prominent voices highlighting silver's potential to outperform gold in the later stages of a bull market. Silver has historically lagged behind gold in the early phases of precious metals rallies, a pattern observed across multiple market cycles. This delay often creates strategic opportunities for investors anticipating silver's eventual breakout. While gold's price roughly quadrupled during the 2003 to 2011 bull market, silver surged nearly tenfold. A similar trend emerged after the 2019 breakout, when silver temporarily outperformed before the COVID-19 pandemic disrupted markets. However, following the 2020 crash, silver resumed its historical pattern by outperforming gold after a key technical retest. What many investors don't realize is that silver's industrial demand profile has evolved significantly compared to previous bull markets. Silver experiences greater price volatility than gold due to its smaller market size and dual role as both a monetary and industrial metal. While this volatility leads to steeper declines during corrections, it also allows for more explosive gains in bullish phases. In recent years, silver's increasing use in solar panels, electric vehicles, and medical applications has created new demand dynamics. As these industries expand, silver's industrial role could provide sustained upward pressure on prices, potentially reshaping its traditional relationship with gold and offering investors new opportunities in the evolving precious metals market.
Alternately gained more than gold and then less than gold, ebbing and flowing over the last 10 years. Okay. And especially since 2024, in March, we put out a report arguing that the stall we'd seen in gold for a couple of years, sideways, was over. We're going up again. Okay. Well, we went from 2,000 to 3,000 during that year since then, a full year now. And silver went from like $25 to $35. A pretty good gain too. Okay. But there are times when silver underperforms. Whenever gold pulls back, silver pulls back more. Okay. Bigger context. Silver's ratio to gold, we measure it by dividing silver into gold, expressing it as a percent, is 1.15% the price of gold now. 1.15. Okay. If you go back 50 years and look at the highest reading of silver in relation to gold, it was dividing the price into the ounce of gold, expressing it as a percent. 2% has occurred in 21 of those 50 years. Okay, so it's almost normal. We're 1.15. Okay. If we break out of the current pullback in silver versus gold, which we argue is now commencing, we're starting to see the breakout. We're going to gush not only to the 2% level, which is to say almost double the price of gold and silver in relation to gold as it is now.
Yeah.
Okay. But you could go further because in bull trends, like in the 79-80 period, or in the 2010-11 period, in the surge, the last 2 years of those bull trends, silver went berserk relative to gold on a percent basis. It ran way out in front of it. And the spread got up to like 3% or higher during those times. So that could mean a tripling of the price of silver at its current level to gold.
Relative to gold.
On a relative level. So yeah, we argue that the silver and the gold and silver miners are now going to beat gold.
Okay.
Going in this next year. And personally, that's where I'm invested.
Okay.
With the emphasis in those areas. They surged out in front of gold dramatically during the 2020 surge in price. That's when we remember the COVID event and the Fed came in and printed and gold soared. But silver and gold vastly beat gold during that 6 to 9 month period. I mean, they trounced it. But then during the period from mid 2020 through about late 2023, they underperformed, meaning while gold went sideways, they eroded downside, a staircase. We technically monitor those spreads. We don't just plot the spread chart, which anybody can do. We do momentum studies of them. And also, what we see with the miners is the same thing we see with silver. We see the technical dynamics of an upturn. In fact, we're on the cusp right now, this month, of posting a close where you measure GDX, for example, versus gold, or the XAU index versus gold, and we're registering a breakout, meaning the performance breakout is occurring. At that point, we expect the miners to beat the pants off gold, as they do periodically. And I think this is in part also due to the breakage of the stock market, because a lot of people in the stock market, when they exit, they're not going to go out and buy silver futures.
Indeed.
Okay? They're going to buy stocks. And frankly, the gold mining stocks in relation to the S&P, gold mining stocks in relation to gold, are vastly cheap and have not gone lower in terms of relative performance. If you go back to 2015, when they were bombed, net price, but also relative performance of the miners, they've never gone lower than that. They've been higher than that level for the last 10 years, meaning the miners, despite the fact that they're not above the 2020 price highs, are actually up more on a percent. XAU index, for example, is up more on a percent basis from its bare low in 2015 than is gold. Tell somebody that at a cocktail party and they'll spill their drink. But it's a fact. They're actually, the XAU is up more than gold is over the last 10 years. And we think it could rush to the upside. We think the potential there is for a tripling of the valuation of miners where they currently are to gold to where they could be over the next year.
Gold and silver are both witnessing strong upward momentum, driven by evolving market conditions and shifting investor sentiment. Bank of America has revised its gold forecasts upward, expecting prices to reach $3,063 per ounce in 2025 and $3,350 per ounce in 2026, citing ongoing economic uncertainty and U.S. trade policy risks as key catalysts. This reflects the increasing role of gold as a hedge against geopolitical instability and inflation, with central banks continuing large-scale purchases. Meanwhile, silver is positioned for even stronger gains as its industrial demand surges due to the rapid expansion of solar energy, electric vehicles, and other high-tech sectors. With governments prioritizing green initiatives and mining output struggling to keep pace, silver prices could exceed $40 per ounce in 2025. That's it for today. Share your thoughts on Michael's analysis in the comments section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.